Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, a while back we told you don't be surprised if we get back to pre-COVID levels. Well, guess what? We're going to show you data that shows exactly that. You're not going to want to miss this, so let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
So Bob, it's interesting because you live in a pretty populated area. It's pretty busy, kind of resortish. And you've been saying ever since, I think not this past Easter, but last Easter, you noticed that all of a sudden there was a drop off. And how's that going?
Yeah, I think it's getting worse. I was telling a story in the room this morning that I know people that own restaurants, and in February, they thought the bottom dropped out and that they were going to have to close their doors. In fact, they asked for forbearance on rents. And when they went to the landlord, which is a huge landlord, and said, hey, FYI, we're not we're telling you we're not going to pay rent till April 1st because of the there's this no sales. And all they said was, we understand. Now, how many times has a landlord just said, we understand? And so he probed around, talked to some other people that are with the same property manager and property owner, and they said kind of everybody swooned in February. It came back a little bit in March, but and then our favorite restaurant just closed. And you know why they closed, Phil? $20 an hour minimum wage now in California for a restaurant and fast food workers. Just because the fast food chains get $20 an hour, if you don't pay it, you get people will just quit on you en masse. And they made a decision that they're closing instead of trying to absorb that extra cost, because it's just not worth to take the risk of running a business with all the other liabilities and not have enough income to make it worth your while. You might as well just quit or do something else. And that's what's happening. We're seeing restaurant after restaurant close their doors in this area. And here's the chart that kind of now makes me understand that we're not alone here in Southern California. This is an amazing chart, Phil.
It really is.
We're pre-COVID. And here's the thing that people don't understand. And this is what really, really angers me about the whole COVID thing. This whole pump got people more leveraged, got people discombobulated, and got people off their game. And now they're taking it all back on you.
Right.
And you're ending up now 4 years later, poorer, more confused, older, and less options. And this is just one of many charts that we've been showing you guys. And if you start seeing massive layoffs in the food service industry, that will affect the unemployment rate, because I don't think how many years have we seen the birth death model of food service always adding jobs. And I think this is going to be bad news. And here in California, we're running an $80 billion deficit. So you're not going to see government workers getting hired here. So those are the two things that have been driving employment, basically, food service and government. And so I think it's a big problem, Phil. What do you think?
Yeah, and I think this is a leading indicator to a lot of stocks that are going to look like this chart as well. And I think ultimately this stuff is sowing the seeds for what we've been kind of pounding the table on lately, and that is that we're going to have some pretty good weakness going into the end of the year. And I think it's just a question of, can they prop it up through the election or not? Post-election, I become very bearish, because unless I see just a renaissance in manufacturing and consumer data, things of that nature, you're just not seeing it. And it's the business cycle, right? The business cycle has cycled out, and we're doing like I said, a wave 5 and a big wave 5 on terms of like the market structure. And it's going to be quite detached from what's going on under the hood. So, this chart, although it's striking, I'm not totally surprised, because I think we figured that the air would come out of the COVID pump. I mean, that was a lot of stimulus, right? I mean, if you look at the M2 chart, how much dollars were pumped into the system? And it was really reckless on the part of the Fed to do that. But that's why I go back to, I think that there's more to it than just that, because you think, well, a monkey could have done what they did, just smash the print button, right? And why didn't they stop printing the minute we made a new high in the market after the COVID dip, right? Because obviously there was stability there at that point. But I think really it comes down to the fact that the banks are all screwed up. The banks are broke. The banks have massive real estate exposure, and the commercial real estate exposure isn't something new. I think they've known about that for quite a long time. And I think that if you really stare at what went down prior to COVID, when they September, I believe it was, Bob, remember they opened up the reverse repo window out of the blue, and you and I were like, why are they doing that? I think this was all just a big banking crisis that got masked over, and you can't bail out banks every couple of years at the expense of the public, at least like how they did it in '08, where they had to come to Congress and get a bailout and things of that nature. And yeah, you could say, well, that whole package actually made money for the government, but it's just bad optics, and it's publicizing. It's just like the banks have to go to the public whenever it's getting too bad for them. Well, what happened here, if I'm correct, it was one of the biggest bank bailouts we've ever seen in our history of modern times. And we're all paying for it. It's no different, except the fact that we're all paying for it through inflation now. And we'll probably end up paying for it through deflation too, through a pretty nasty recession. So we all bailed out the banks, I think, in a very stealth, very disguised manner. They used COVID as a cover, but I think the amount of printing and the fact they didn't stop printing was all just to keep the banks propped up. And even then, we did not save all the banks. Look at Silicon Valley. They just couldn't do it, couldn't save them. So I think banks are still in a big heap of trouble, and the Feds probably just resolved to the fact that the GSIBs, right, the globally strategic important banks, the Chases, the Bank of Americas, those guys, they're just going to gobble up whatever's left, and they'll be mandated to do so, and then we'll carry on. But I think that's kind of the vicious part of this whole thing, is that once again we had to bail everybody out.
Yeah, I don't know how a family of four can actually go out to eat more than, luckily, maybe once a month. I mean, there's just two of us now, and you go out to eat, you're at $100, for dinner, and if you get drinks, you're at $150 with tax and tip. And I think I said this before, it's more expensive for me to go out to eat dinner here than it was for me to go out to eat in Tahiti, which is just a crime. If let's say you make $100,000 a year, if you go out to eat once a week, you're dedicating almost 15 to 20% of your net income to going out to eat. I mean, think that is absolutely insane. $12,000 a year to go out to eat, and what are you getting? You're getting burgers and pizza and pasta. It's not like you're rolling in, getting some nice steaks and stuff like that. They just nickel and dime you to death. And I think this is ending. And I'm always worried about the second order events, Phil. A restaurant closes. That's another piece of commercial real estate that's not generating income. Well, who pays for that? The pension fund, the institutional fund, or the bank, right? All those people are losing their jobs. Those people tend to be, and I don't use it pejoratively, they're less educated. Their skills are limited, right, to hospitality. So where are they going to work? Retailers are closing down, and limiting. And what else I'm seeing, Phil, is interesting, is that I'm seeing hours are being cut and choices are being cut too. So this is going kind of back to my thought is that prices may stay elevated, but just less and less people are going to be able to afford it. So we're going to get a general shrink in the economy, I think. And at some point, that just blows the stock market up. And so we're going to have to see here. We get a little bit of an interesting test now in the markets, a little couple days swoon. Yep. We'll see if that manifests in anything else, or if that's just a roller coaster dip for the next push higher. But, VIX is pushed up over 15, and I'm hearing that maybe up to 18, but I think this is maybe just setting the stage to get ready for the earnings reports that are coming out here in the next couple of weeks. So no crash yet, but every time I get this data, I'm just sitting there saying, I guess I get more depressed than anything else, to seeing how basically you're watching a chess match and you're going to lose.
Right. Remember, we talked about that daily 9 EMA and that other video we did the other day, which you guys liked the technical analysis, and we'll do more of that. And we'll get to Bitcoin tomorrow as well. But, if we get another close under that daily 9 EMA, got to watch out, because statistically that means more downside, and potentially we could go down to the weekly 9 EMA. And Bob, I was also looking at the seasonality. Normal seasonality is very bullish through this time period, except when it's the fourth presidential year, and that's what we have here. And the difference in that would be that we don't really gain any ground until we start getting out of May, and then you start getting that effect of ramping up into the election, because they got to make everything look good, right? So we could be range bound for a few weeks here. and we could definitely poke lower.
Well, I mean, look, we had a Viagra moment from January 1st until last week. I mean, we're blowing away every seasonality thing that we ever seen. January swoon, no. February swoon, no. March swoon, no. Now we're finally into April, and maybe they're testing. Hey, there is gravity here, so we may have to maybe get a pullback just to bring things back into balance here before they move higher. But at any point, this market's kind of sketchy, so just be smart. Good news, Phil. Energy's up, uranium's up, gold's up, silver's up. Energy markets love when interest rates go higher. Guys, just look at that, watch it every day. As long as that 10-year, 20 years pushing up, you can almost guarantee oil's going up with it, which I find fascinating. It's a great hedge trade if you play it, and then you can just go and sell calls against both sides and be like a broker. But anyway, we're rambling now, Phil. We'll catch you guys tomorrow. We'll definitely do Bitcoin. This chart came up, and I pushed Phil off the Bitcoin, and there'll be enough to talk about tomorrow with what we think is going to happen here over the halving in the next couple weeks after that. Phil, thanks for everything. We'll catch you guys tomorrow.
Trade Genius.